Welcome back to Wall Street Podcast. Today we're doing a deep dive into Pop Mart, that trendy art toy giant. Our main source here is a recent Morgan Stanley Asia Pacific Insight report. It's called IP Conglomerate, Scaling Beyond Expectations, and it just came out Juneteenth, 2025.
Yeah, and it's a pretty fascinating report. It really digs into Pop Mart's, well, surprising global growth, almost exponential, actually.
Especially North America and Europe, right?
Exactly. And a lot of it seems fueled by social media, just going viral. Morgan Stanley's take is interesting, too. They say the current stock price, yeah, it reflects the amazing 2025 growth we're seeing.
Okay.
But it hasn't fully captured the long-term scale, the real potential down the line. They've actually upped their earnings forecasts quite a bit for 2026 and 2027.
Right. So today we're trying to figure out, how did Pop Mart pull this off, this huge global growth for an art toy company? What's their secret sauce? What are their next moves? And maybe most importantly for you, what are the risks investors need to keep an eye on? Let's start with the basics. Their core business and how they're performing in the market.
Okay. So fundamentally, Pop Mart's strategy is about mixing things up. They have a diverse set of intellectual properties, IPs, right? And they combine that with really skilled operations. That combo lets them keep growing, keep putting out new stuff consistently.
And that phrase in the report, index-level growth in North America and Europe, that really jumps out. It's not just good growth. It sounds like growth that maybe even surprised Pop Mart themselves.
I think that's fair to say. It implies a pace, almost like a whole market index rising.
Actually,
and yeah, a lot of this seems deeply tied to social media. You've probably seen the videos online. Huge lines outside stores, celebrities with Pop Mart charms on their bags.
yeah, those Labubu charms especially.
Exactly. And their main customers, young people, over 70% female, they're super connected online. So you get these big bandwagon effects.
The Labubu thing is kind of wild. Google Trends data is showing its popularity, even briefly, up there with giants like Harry Potter or Star Wars. Though we should be clear, right? Actual awareness in the West is still way lower than those huge established names. It's hype, but maybe not deep penetration yet.
That's a really important distinction. It brings up the question of, how long can this last? But if you look at the broader market context, the whole IP product retail space is massive. Think about comparable companies. Disney, Bandai Namco, Sanrio, Lego, Funko. Together, they hit $77 billion in retail sales last year.
Wow.
And that's projected to hit $88 billion by 2027. Now, Morgan Stanley forecasts Pop Mart grabbing maybe a 6-7% share of that by 2027. That's about $6 billion in sales.
So going from, what, under $1 billion just a couple of years ago to $6 billion, that's aggressive.
It's huge, and definitely a serious footprint for a company that's relatively new on the global stage.
And the stock performance certainly tells that story. Up 175% year to date. Compared to the Hang Seng China Enterprises Index gain of, what, 24%? It's night and day.
Clearly, the market has reacted strongly to this immediate growth surge.
Right.
But here's the nuance Morgan Stanley points out. While that 2025 exponential growth seems fully priced in.
Meaning investors expect it now.
Exactly. They believe the market hasn't fully grasped the long-term picture, the ultimate scale Pop Mart could reach. And that's where their financial forecasts get really interesting.
Okay, let's dive into those numbers then. Morgan Stanley has bumped up Pop Mart's earnings per share, the EPS forecasts. How much?
Significantly. For 2025, it's up 6%. For 2026, it's up 15%. And for 2027, it's up 21%.
Oh, okay.
And they specifically point to that clearer growth path they're seeing now in North America and Europe as the reason.
And their profit forecasts are even bolder compared to what others are saying?
Yeah, much higher than the consensus. They're projecting net profits going from RMB 7.3 billion in 2025 up to RMB 13.2 billion by 2027. That's like 21 to 25% higher than the average analyst forecast out there. It shows real conviction on their part.
And the sales path.
Just as steep. They see sales climbing from $7.9 billion in 2023, hitting $1.8 billion in 2024, then soaring to $3.6 billion in 2025, $4.9 billion in 2026, and hitting that $6 billion mark in 2027.
No question. One thing the report does flag, though, is rising costs tied to e-commerce.
Okay.
Those might put a bit of pressure on net profit margins in 2025. It suggests they need to invest heavily in infrastructure, not just marketing and scaling ops. It's that classic growing pain.
Right, the cost of rapid expansion. You need the back end to support the front end. But what's actually driving this incredible growth? Let's get into the catalysts. Well, the initial spark, like we touched on, was definitely social media. The report points to the Blackpink member Lisa showing off her Pop Mart collection back in March-April 2024.
Right, that seemed to go everywhere.
It really did. Generated tons of viral content, and since Pop Mart's core audience are heavy social media users, it just amplified globally. It was like lighting a match.
But it can't just be celebrity endorsements,
Yeah,
right?
right.
The product has to resonate.
Absolutely. And the Labubu plush toys, launched late 2023, were key. They sort of transcended being just toys and became fashion accessories. That broadened the market significantly.
Okay, so it's a hot product. But how do they keep it going? Avoid being a one-hit wonder.
That's the crucial part. The report emphasizes Labubu isn't just one thing. There are multiple generations of these vinyl plush blind boxes. The first 3 sold out, a 4th is coming. There are non-blind box plush toys. There are 3 4-figure series every year. Even Labubu Pop Blocks Building Blocks launched in the US in May and sold out online pretty fast. It shows diversified appeal within just that one IP.
So a constant stream of newness around the popular IP.
Exactly, and they're layering on top of that. Their theme park, Popland, has character performances. There was apparently a viral video of a Zamomo character dance. Plus, they've got animation shorts coming this summer. 24 short episodes. It all works together to build the IP's profile and keep the buzz going.
It sounds like a much broader strategy than just selling toys. They're building character worlds.
That's a good way to put it. And it raises the big question. Is this North American and European craze just temporary? The report argues probably not. They look at China, where Pop Mart has seen sustained growth for 5-6 years now, since about 2019.
Even with high store density there.
Right. So they think these overseas markets are so vast, it might take several years for Pop Mart to really become a household name. Similar to how it played out in China, this isn't necessarily a flash in the pan.
And the potential size of the North American market alone is, well, huge. Morgan Stanley thinks North American sales could eventually match China's sales, maybe by 2028 or 2029.
That's their base case assumption. And when you look at the comparisons, it makes sense. The U.S. apparel and footwear market, 16% bigger than China's. U.S. movie box office, about 50% higher.
And people can just afford more discretionary items.
Exactly. U.S. per capita GDP is way higher, like 560% higher than China's. That means more disposable income for things like IP products. Plus, Pop Mart is pricing higher in the U.S. Their new products are often 100% more expensive than in China, like figures around $19 versus maybe $9.60. Plush toys near 28 cents.
So same number of items sold means much higher revenue.
Correct. The Lego comparison they draw is pretty stark, too. Lego's 2024 revenue in the Americas was almost 400% higher than its Asia-Pacific revenue.
Wow.
It just illustrates the massive potential scale for Pop Mart as it expands beyond Asia.
Okay, so the core business is booming, fueled by social media and smart product strategy with huge overseas potential, but they're also branching out, right, into new areas.
They are, and it seems guided by this philosophy the report mentions. Ambition big, start small. They put time and effort into building good products and IPs first.
Makes sense.
Yeah.
So what are these new ventures?
2 main ones highlighted,
Right.
plus the Pop Blocks we mentioned. First, Popland. That's their IP theme park. Phase 1 opened in Beijing, latter half of 2023.
A theme park already.
Well, sort of. It's profitable, making maybe RMB 300, 500 million a year, but it's pretty small right now, like the size of a couple of big supermarkets.
Okay.
And it doesn't have major thrill rides yet.
Okay, so start small definitely applies there.
Right. But they've got adjacent land secured for future expansion, potentially adding more traditional amusement facilities. The long-term vision is a big park. But interestingly, they see it less as a direct profit driver compared to toys, and more as a platform for IP incubation, fan interaction, brand awareness, keeping the hype alive. It's strategic.
Building the brand experience, the ecosystem. Got it. What's the second venture?
That's POPOP. It's their fashion jewelry brand. They launched it early 2025, starting with pop-ups, then a full store in Shanghai.
Jewelry. How does that fit?
It actually seems like a really smart move. Remember, 70-75% of their customers are women, described as fashion conscious. The products use Pop Mart's popular IPs, made with silver or 14K gold, priced from around RMB 400 to 2,000.
Get a market opportunity.
Huge. The global fashion jewelry market is over $50 billion annually, and it's very fragmented. So POPP can leverage Pop Mart's existing IP recognition to stand out quickly. Plus, their existing global direct-to-consumer stores make rolling it out internationally much easier. High potential there.
And the third one, Pop Blocks.
Right, the building blocks. They see this as potentially a really significant business long-term, though developing the products and supply chain takes time. The key differentiator is their own IPs. These aren't just building sets. They're positioned more as, like, cool display pieces featuring characters people love.
And focus more overseas.
Yeah, North America and Europe are primary targets, partly because of larger home spaces for display, and partly because there's just a more established culture around block building. We saw the Labubu Pop Blocks launched in the US in May and sold out online, so there's definitely demand. They plan to expand the range, different price points, difficulties, using more IPs, even licensed ones from Japan eventually.
Okay, so expanding into parks, jewelry blocks, it really paints a picture of a company trying to become more than just toys. How does this all tie into their competitive edge and ultimately their valuation?
Well, Pop Mart's big advantage is its highly integrated model. This really sets them apart. They own their IPs, they co-design the products with the artists, and critically, they sell directly to consumers DTC through their own channels. That's over 90% of their sales.
Right, which is very different from, say, Disney or Sanrio, who mostly license out their IP.
Exactly. Or different from Lego, Bandai Namco, Funko, who often license in IPs from others. Pop Mart controls almost the whole chain.
And that translates to better economics.
Dramatically better. Morgan Stanley estimates Pop Mart makes about 36 cents in operating profit for every retail dollar. Compare that to a pure IP licensor who might only make about 7 cents.
Wow, that's a huge difference.
It's massive. It gives them way more capital to reinvest in developing new IPs, building out those DTC channels, innovating products. It becomes a powerful, self-reinforcing cycle.
And the direct connection to fans must be valuable too.
Absolutely. Consistent, weekly new product drops, available right through their official channels. Loyal customers know exactly where and when to look. It builds a really strong relationship.
Plus the IPs themselves coming from artists who are often still active creatives. That feels unique.
It does. Like Kessing Lung, the creator of the monstrous Labubu. He's still doing his own art. One of his paintings sold for a good chunk of change last year. And their long-term content plans, starting with animation shorts, potentially movies down the line, will only strengthen that IP value further.
So Morgan Stanley argues all this. The integrated model, the diverse IPs, the operational strength, justifies a premium valuation compared to peers.
That's their argument. When you look at comps like Disney, Bandai Namco, Centaurio, they often trade at high PEG multiples, price earnings to growth.
Which basically means the market is willing to pay up for their durability and strong IP monetization, right?
Exactly. Investors recognize the long-term value and the competitive moats these companies have built. Now, Pop Mart's current PE ratio is 41 times for 2025, 28 times for 2026 based on MS forecasts already reflect that massive short-term growth. But the argument is the market is still too focused on the short term. It hasn't fully priced in the long-term potential, the possibility that Pop Mart could reach a scale comparable to those global giants.
So Morgan Stanley raised their target PE for 2025 to 51x.
Yes, which implies about a 35x PE and a 1.5x PEG for 2026. It signals strong confidence in that global expansion story playing out over the long run.
Okay, it's a compelling growth story, but no company grows this fast without facing challenges. Let's talk about the risks. The report mentions execution demands.
Yeah, this explosive growth, even surprising management apparently, puts immense strain on the whole operation. Supply chain, internal processes, they're stretched thin, they've had multiple budget adjustments, and when you're moving this fast, mistakes get a lot more expensive.
That leads to internal risks too, like cannibalization.
Right. If Labubu becomes too dominant, does it squeeze out oxygen for their other IPs or product lines? It's a balancing act. The report notes they intentionally don't immediately restock Labubu plush toys, partly to manage this.
Interesting. And scalpers. That's always an issue with hot collectibles.
Definitely. When things sell out instantly and waits are long, it frustrates genuine customers and fuels the scalper market. Pop Mart plans to increase supply, which might cool down resale prices, but their main focus seems to be avoiding that cannibalization issue.
Counterfeits must be a huge headache too.
A major concern. Lots of Labubu fakes are reportedly out there, even unauthorized factories bragging about orders. That can seriously devalue the IP if it gets out of control.
Any other internal risks mentioned?
A couple of more nuanced ones. Potential backlash from, say, luxury influencers who don't like seeing toy charms on high-end bags might impact a certain segment. And the big one, traffic conversion. Can they successfully turn all this Labubu hype into sustained interest across their whole portfolio? The quality of new content, like those upcoming animations, will be really critical here.
Okay, those are internal pressures. What about broader market or macro risks?
Well, the new consumption stock sector in China, where Pop Mart sits, has had a huge run-up, 93% since late February, way ahead of the broader consumer sector.
So it's potentially crowded.
Potentially, valuations have climbed. There's a risk of investors taking profits or rotating out of that sector sometime in late 2025 or 2026, which could hit Pop Mart's valuation in the short term, regardless of fundamentals.
And trade tensions, always a factor for global companies.
It's definitely flagged. Pop Mart is being proactive, shifting its U.S.-bound supply chain out of China, first to Vietnam, with plans for Mexico eventually to mitigate tariff risks. But there's always that black swan risk. Could a successful Chinese brand entering the U.S. market become a target in broader U.S.-China friction? It's something to keep in mind.
Plus the usual suspects. A weak macro environment hurting consumer spending, failing to create appealing new products consistently, or just stumbling in their overseas expansion efforts.
Exactly. Those are always risks for any growing consumer brand.
All right, let's dig a bit deeper into some key themes with our Q&A section. First, that sustainability question around viral growth. We talked a lot about Labubu's explosion. How exactly does Pop Mart's multi-IP strategy and that integrated model make this potentially more sustainable than just a single fad? Why does Morgan Stanley see a longer runway here?
Right, it's the core question. The social media spark, the Lisa effect, the Google Trends spike that got things going. But the sustainability comes from Pop Mart's IP product flywheel theory. It's not just about one hot SKU. It's about constantly releasing diverse, appealing products across an IP blind boxes, figures, plush, blocks. Look at Labubu. Multiple generations, different formats. This constant refresh keeps the IP relevant and engaging long after the initial viral peak.
So the product pipeline itself sustains the IP momentum.
That's the idea. And the integrated model fuels this. Owning the IP, co-creating with artists, controlling the DTC channels. It gives them immense control and efficiency. Unlike a pure licensor, they get direct fan feedback. They control the release cadence, like those weekly drops. And crucially, they capture much higher profits per sale.
Which they can reinvest into more IPs and products.
Exactly. It creates a stronger foundation. And you can look at their China experience. 5 to 6 years of sustained growth there suggests their model can maintain momentum beyond initial hype. Plus, remember, they are actively developing tailored plans for their other major IPs like Molly, Demu, Skull Panda. It's not just the Labubu show. That diversification is key to Morgan Stanley's belief in long-term sustainable growth.
Okay, second question. Moving beyond toys. Popland, POP jewelry, pop blocks, they have different profit profiles, different market dynamics. How important are these new ventures, really, in shaping Pop Mart's long-term value and market position, especially as they expand globally?
They're strategically crucial, even if Popland, for instance, isn't going to match the core toy business on pure margin percentage anytime soon. Popland's value is as that IP incubation, fan interaction, and brand visibility platform. It's about creating a physical world for the IPs, deepening the connection. It embodies that ambition, big, start small approach.
It's part of building the overall brand ecosystem.
Precisely. POPOP jewelry is a great example of leveraging their existing strengths. They tapped into their core female fashion-conscious demographic in a huge fragmented market where their IP recognition gives them an immediate edge. Global rollout is easier because they already have the DTC infrastructure.
And Pop Blocks seems targeted at a specific, potentially lucrative overseas market.
Right. North America and Europe, where block culture and display space are more common, again, their unique IPs differentiate them. These are collectibles, display pieces, not just generic building toys. Taken together, these ventures are transforming Pop Mart. They're moving from just selling toys to creating a broader IP ecosystem, maybe even a lifestyle brand. That transformation, that broader potential, is what Morgan Stanley believes isn't fully baked into the current valuation yet. The animation and movie plans are also part of weaving this larger ecosystem together.
All right, final question. We've laid out the impressive growth, but also a significant list of risks, execution challenges, scalpers, counterfeits, trade tensions, a potentially crowded sector.
Yeah.
How should an investor balance these serious headwinds against that compelling growth story? What does that overweight rating from Morgan Stanley ultimately signify?
It signifies that despite acknowledging all those risks, and they are significant, Morgan Stanley believes the potential rewards outweigh them. The operational strains from rapid growth are real. Managing supply chains and avoiding costly errors is paramount. Market dynamics like scalpers and counterfeits need constant vigilance. Scalpers hurt the fan experience, while fakes directly threaten the IP's value. Pop Mart needs to keep investing in supply and anti-counterfeiting measures.
And the challenge of converting that Labubu buzz.
That's critical. They need to prove they can transition fans to other IPs and their new ventures. The quality bar for things like the animation shorts will be high. Trade tensions are a geopolitical reality they're navigating by diversifying production. And the crowded new consumption sector means their stock might be sensitive to sector rotation or profit-taking, especially after its strong run.
So given all that, the overweight rating implies.
It implies a belief that the market is still underestimating Pop Mart's long-term trajectory. They think the company's integrated model, diverse IP pipeline, and global expansion strategy provide a durable growth path that can overcome these challenges. Essentially, Morgan Stanley sees more upside potential driven by that long-term global scale and ecosystem development than downside risk from the current headwinds, even with the 2025 growth largely priced in. They're betting on the durability and ultimate scale of the Pop Mart model.
Okay, quite a journey. We've navigated Pop Mart's, frankly, astonishing global expansion, unpacked their integrated IP strategy, looked at the new ventures, theme parks, jewelry, blocks, and really weighed the risks and challenges. As Pop Mart shows just how powerful IP can be, crossing categories and tapping into emotional connections, maybe here's something to think about. How might this trend change the way we value consumer brands in the long run? Could that emotional connection become a much more concrete factor for investors? Something to ponder. Thank you for joining us on this deep dive today. Keep seeking those insights, keep asking questions, and we'll catch you next time to unpack another fascinating topic.